Welcome to today's Did You Know video. We are going to talk about FIRPTA today, which is a little known tax act that buyers need to be aware exists. So FIRPTA stands for the Foreign Investment in Real Property Tax Act. And Congress passed this in 1980 as a way to give the federal government their first authority to withhold taxes from foreign sellers when they're selling real property in the United States. So the withholding was intended to ensure U.S. taxation of any of those gains realized when those sellers are selling real property before those funds left the United States. And what does the IRS say a foreign person is, so that we know what that definition is? This was cut and pasted directly from the IRS website, and as defined by the IRS tax code, a foreign person is a non-resident alien individual. A lot of these other sections are about corporations, foreign trusts, foreign estates, and partnerships. And most of the time, that's not what we're dealing with in a real estate transaction when you just have a buyer and a seller involved. But do know that those can be foreign as well. If you're buying an investment property from a foreign seller, this would apply as well in that situation. But most of the time, we're talking about an individual selling to an individual, and it's a non-resident and alien individual and a resident alien individual. So it still doesn't need to be a U.S. citizen, but a resident alien individual is not subject to FIRPTA withholding. And a resident alien is a resident that has a green card, or they've passed the presence test, which means that they've been in the United States for a certain number of days in the year, and they qualify then to be called a resident. So what do buyers need to know about this, and why am I even talking about it? The reason is because the tax code says that the transferee, which is the buyer, is considered the withholding agent, and they have to retain 10% or 15% of the gross purchase price, so not the net proceeds, but the entire purchase price, to send to the IRS with the required documentation. And if that seller is a foreign person and the buyer fails to withhold this amount, then the buyer is going to be liable for those taxes plus any penalties incurred if that seller leaves the country and does not file a U.S. tax return in the following year. So if on a $400,000 house, which is actually below median here in Fort Collins, we're talking about a $40,000 if it's the 10%, or $60,000 if it's the 15%, plus any penalties that the buyer would have to come up with and could be liable for if they don't withhold this in a transaction. And a little note here, but if the sales are less than $300,000, they're exempt if the buyer is going to be occupying the property. Not very many homes sell up here in northern Colorado for under $3,000, so basically this is applying to most transactions in northern Colorado. And the reason I'm bringing this up is buyers are really unaware that this even exists. So you need to realize that it is your responsibility to determine if that seller is a foreign person and whether they're going to be subject to FIRPTA withholding. And then if they are, you need to make sure that you're withholding this amount. And in reality, it's the settlement agent, so it's usually the title company or an attorney that is going to do this for you. And you can instruct them to deduct that 10% or 15%, and I have another chart that shows when it's 10 and when it's 15. And then you're going to submit that to the IRS, or the title company or attorney might hold that in escrow if the seller has an application pending for a withholding certificate that says that they either don't owe it, or they owe a reduced amount, or they can get it back sooner. So they can sometimes mail it off, and they can sometimes hold it in-house in escrow as they wait this to be processed. So how much is going to be withheld? How does this work, and when does the 15 and when does the 10 apply? So if the gross sales price and the buyer is here, and the buyer intends to use this as a residence, then if the purchase price is under $300,000, it doesn't apply. If the purchase price is between $300,000 and $1 million, then it's the 10%. And if for any sales over $1 million where the buyer is going to occupy, it's 15%. If the buyer is intending on using this as an investment property and it is never going to be a residence, then the 15 applies on all three categories. So how exactly does this work? Kind of like I said in the slide before, that settlement agent, so your title rep, is going to withhold those funds during closing, and that amount is going to show up on the settlement statement. So if you've bought or sold a house recently, you're going to remember about a day or two before closing, the title company sends you these settlement statements, and it shows seller and buyer. And on the seller, you're going to have a credit for how much the buyer is paying for the property, and then you're going to have a column of debits. And in that debit is going to be the 10% or the 15%, whichever applies in that case. So they're going to see in advance that this is being withheld and how those numbers are going to work. Then during the closing, the settlement agent is going to retain these funds. They're going to pull them and have that check held in a separate account, and then within 20 days of closing, they have to mail that to the IRS. And then the IRS is going to hold those funds until all of the taxes that are due have been paid and that they're comfortable with that. So that leads me to say, what should sellers know about this? Because the fact that the IRS can hold on to these funds for a significant amount of time can really affect how a seller was planning on using those funds in the first place. So if you are a foreign person that is a non-resident alien, then you have real property in the United States and you're attempting to sell it, the first thing you need to do is definitely find a realtor that's familiar with FIRPTA withholding and the paperwork involved with getting the ball rolling in the beginning before you even list your property for sale. And then they can help you determine what your FIRPTA status is and whether that's going to apply to your home sale or not. You can also contact your accountant to find out what category you fall into. And then if applicable, and you think that you shouldn't have it withheld, or there are other reasons why the withholding should be less, you can apply for a withholding certificate, which can eliminate or reduce that amount. It can also reduce the amount of time that the IRS keeps those funds from you. And advanced preparation for this is crucial before closing, because this would need to be, the certificate would need to be in the closer's hands, so that settlement agent would need to have this before they can say whether they're going to hold it from you or not. Without this, they're going to automatically withhold it. So if taxes are due and you are subject to FIRPTA, prepare for how that's going to affect your purchasability in the future or any of your financial plans. If you were planning on going from one closing where you sell your house to another one where you use those proceeds to purchase the next house, and you didn't know that you were subject to this and you just walked out with $60,000 or $80,000 or $90,000 less than you thought, you might now be in default on that second property. Not only will you not be able to buy it, but your earnest money is at risk. So figuring this out in advance before you sell your property is really key, in addition to the fact that the IRS can hold this for up to 18 months depending on the time of your sale. If you end up closing in January of one year, those taxes aren't going to be filed until February, March, April of the next year, assuming you don't file an extension. So you're at least 16 months away from being able to get any refund that might be due to you. So this can change how you decide when to sell your house and to make sure that you're not without those funds for a significant amount of time. So definitely speak to your realtor, make sure you talk to your accountant, research this. It's really easy to find in the tax code. It's not that hard to read either, and there are a lot of links there and explanations for how to fill out the forms. And if you have any questions, feel free to reach out, because this is FIRPTA and why buyers need to be aware of how this works in a real estate transaction. So thanks for tuning in for today's Did You Know video.